Look, somewhere around 2022, something shifted. And I don't mean culturally, I mean mathematically. Young people looked at the deal their parents accepted: 40 years of employment, a pension, a house, a retirement at 65, and they did the math on it, quietly, without making a big announcement. And then a significant number of them just didn't take the deal. Not because they were lazy, not because TikTok rotted their ambition, but because the spreadsheet didn't close. The numbers didn't work. You work 40 years, you give your best hours to a company that will replace you with a cheaper version the moment it becomes convenient. You delay every meaningful experience until your knees hurt, and what do you get? A watch? A LinkedIn post that says, "We wish John well in his future endeavors"? There are currently millions of people in their 20s who looked at that system, looked at what it costs in time and optionality and compounded life decisions, and said no thank you. And the really interesting part isn't that they said no. The interesting part is that they were right to say no. And the even more interesting part, the part almost nobody is talking about, is that their version of freedom is quietly building more wealth than the security track ever did. We're going to explain exactly how that works and why it's getting weird. The central metaphor I want you to hold on to for this entire video is an escalator, not a staircase. An escalator, the traditional life system, degree, job, mortgage, 401k, retirement, that's an escalator. It moves in one direction, at one speed. You don't control the speed. You don't control the direction. You can stand still on it and still technically move forward, which is both its appeal and its trap. And here's the thing about escalators. They work fine when they're working, but they have one catastrophic design flaw. If the escalator is going the wrong direction, or if it's broken, or if the destination it leads to no longer exists, you still arrive, slowly, inevitably, at the wrong place. Gen Z stepped off the escalator, some of them jumped off, some of them got pushed off, and some of them looked at where the escalator was going and very calmly took the stairs instead. This video is about why, and more importantly, it's about what the math looks like when you're on the stairs versus when you're on the escalator. Let me start with the security deal itself, because I think most people my age have a vague sense that the old path doesn't work anymore, but they don't have the specific, granular, uncomfortable numbers to explain why. So let me give you the numbers. The average Gen Z worker entering the labor market in early 2026 earns somewhere around $40,000 in their first year. That's gross. After taxes, in a moderate cost of living state, you're taking home something like $31,000, $32,000. Call it $2,700 a month. The median rent for a one-bedroom apartment in a city with actual job opportunities, not a shrinking Rust Belt town, but a place where the jobs are, is running around $1,800 to $2,200 a month. So you're spending conservatively 65 to 70% of your take-home income on a single line item before you buy a single meal or pay a single bill. And the response from the older generation is traditionally, well, you need to move somewhere cheaper. Sure. And then your career opportunities narrow. Your network shrinks, and you accept a lower salary which partially offsets the lower rent, and you're more or less back to the same ratio. The math doesn't change because you move the geography. Now let's talk about the house, the thing that was supposed to be the cornerstone of middle-class wealth accumulation. The median home price crossed $420,000 in early 2026. The standard down payment is 20% to avoid private mortgage insurance. That's $84,000. Cash, just to open the door. At a savings rate of $500 a month, which given the math I just showed you is genuinely aggressive on a $40,000 salary, you are looking at roughly 14 years to save that down payment. You'll be in your mid-30s before you can buy a median home in a market where jobs exist. And by then, if home prices continue at their historical rate of appreciation, the median home will cost considerably more and your down payment target will have moved. It's not a ladder, it's a treadmill. You run, and the destination maintains its distance. I want to be fair here. This isn't about blaming a generation above. This isn't a boomers had it easy rant. That framing is lazy and it misses the actual mechanism. The actual mechanism is that the system was designed for a specific set of economic conditions that no longer exist. Cheap housing relative to income, stable long-term employment, real pension guarantees, inflation that matched wage growth. Those conditions existed for a few decades in the mid-20th century in the United States. They were not the historical norm, they were an anomaly. And people built a life philosophy around an anomaly, and now the anomaly is over and the philosophy is still being handed down like scripture. That's the problem, not the people. The philosophy. The escalator was built for a different building and nobody updated the map. Here's where Gen Z's thinking starts to diverge from the conventional narrative in an interesting way. The conventional narrative says Gen Z values freedom because they're immature. They don't want responsibility. They want to travel and post on Instagram and avoid the hard work of building a stable life. And I think that framing is not only wrong, it's almost perfectly backwards. Because when you actually look at what a significant portion of Gen Z is doing with their financial lives, you see something that looks less like avoidance and more like rational optimization under constraint. They looked at the options available to them, they priced out each option in terms of time, money, and optionality, and they chose the one with the best expected value. That's not immaturity, that's math. Around 44% of Gen Z currently has some form of independent income stream separate from their primary employment. Freelance work, content creation, e-commerce, digital products, service businesses that can operate remotely. That number was closer to 22% for millennials at the same age. It doubled in roughly a decade, and the mechanism driving that doubling isn't ambition or hustle culture. It's something colder and more structural. It's that the internet reduced the cost of starting a business to approximately zero. And when the cost of starting a business drops to zero, the rational move for anyone with skills and time is to experiment. You're not betting your savings, you're not quitting your job, you're running a parallel process. You're hedging. This is the first escalation. The traditional security system was built on the assumption that employment was the only viable path to income. Not because that was philosophically true, but because the infrastructure costs of alternative paths were prohibitive. You needed capital to start a business. You needed distribution to reach customers. You needed inventory or office space or equipment or employees. All of that required money you didn't have. The escalator was the only option available to most people at most times, and so security became synonymous with employment. But that infrastructure barrier is gone now, completely gone. And when the barrier disappears, the reasoning that was built on the existence of the barrier also disappears. But the older generation's advice didn't update. It kept recommending the escalator as if the stairs didn't exist. And Gen Z looked at the stairs and said, these seem fine actually. Now, here's where I want to introduce the first uncomfortable reversal, because I know what some of you are thinking. You're thinking, okay, but the people who went the traditional route still end up with more stability. The job has benefits. The job has a 401k match. The job has health insurance. The job is safe, and I understand that intuition. But let me challenge it with a specific number. The average corporate employee in America receives a 2.8% annual raise. Inflation ran at 6 to 8% for multiple years in the early part of this decade. That means, in real terms, the average employed person was receiving a negative raise every year for multiple years in a row. Their nominal number went up. Their actual purchasing power went down. They were standing on the escalator watching it move, feeling like they were making progress, and actually going backward relative to the cost of living. The safety was an illusion, a well-marketed, deeply believed, socially reinforced illusion. But an illusion. The person who instead spent those same years building a service business, or a content channel, or a portfolio of digital products, or a remote consultancy, that person had no salary floor but also had no salary ceiling. Their income was directly tied to the value they produced and the market's willingness to pay for it, which means their compensation tracked market conditions instead of HR policy. And in an inflationary environment, market prices rise. A freelancer can raise their rates. An employee needs to have a conversation with a manager who has a budget cap. The escalator has a speed limit. The stairs don't. Let me give you a concrete scenario here so this isn't abstract. Take two people, both 22 years old, both intelligent, both hardworking, both starting from zero. Call them the first one Alex and the second one Jordan. Alex takes the traditional path, job at a mid-sized company, $50,000 a year, 2.8% annual raises, maxing the 401k with a 3% employer match. Alex is doing everything right. By the textbook, Jordan takes the uncertain path. Jordan builds a small content operation in a niche they understand. Year 1, Jordan makes $11,000 from it. Year 2, $23,000. Year 3, $51,000. Year 5, $140,000 because now Jordan has an audience, a product licensing deals, and a consulting rate that commands $500 an hour because of the public credibility the content built. Now here's the math. By year 5, Alex is making $57,000, has maybe $40,000 in the 401k, and has a mortgage application that's still borderline because the bank wants to see 2 years of higher income to qualify for the house price range Alex is targeting. Jordan, by year 5, is making $140,000, has complete location independence, works with clients of their choosing, and, critically, owns the asset that generates the income. Jordan's content library, audience, and brand are assets with compounding value. Alex's employment is a cash flow that disappears the moment the employment relationship ends. These are not the same thing. One person built an asset. One person rented their time. I want to be clear, not every Jordan wins. Most people who try the independent route don't reach $140,000 by year 5. Some never get off the ground. The uncertainty is real. But here's the point that gets missed in every conversation about this. The Alex path isn't safe either. It just feels safe. The illusion of safety is one of the most expensive things you can buy. Because when you believe you're safe, you stop optimizing, you stop developing assets. You just ride the escalator and trust that it's going somewhere good. And then one day restructuring happens, or outsourcing happens. Or the company gets acquired and your role is eliminated. And you're 45 years old with a gap in your resume and a 401k that you can't touch without penalties and a lifestyle that requires your current salary to sustain. That's not security. That's fragility wearing a good outfit. Alright, if you find this kind of analysis useful, looking at systems instead of just surfaces, hit subscribe. I break down financial mechanics like this every week. No motivation, no hype, just how the machine actually works. Here's where the story gets genuinely interesting, and this is the second escalation, because there's a generation above Gen Z, call it late millennials, who saw the same broken deal and responded differently. They tried to optimize the old system instead of replacing it. They hustled, they got multiple degrees, they did everything the escalator told them to do, and then did extra. And a lot of them ended up with $200,000 in student debt for credentials that appreciated in perceived value, but depreciated in market value. Because everyone else did the same thing simultaneously. When a credential becomes near universal, it stops being differentiating. It becomes a baseline, an entry fee, not a competitive advantage. The average millennial hit net zero, meaning they finished paying off their student loans at age 35. That's 13 years of compounding lost. 13 years where that money could have been buying assets instead of servicing a debt. For an escalator ticket that turned out to be standing room only on the way to a destination that was already crowded. Gen Z watched this happen in real time. They watched their older siblings and cousins and the people 5 years ahead of them go through it, and they updated their priors accordingly. That's not laziness. That's learning from observed evidence instead of received wisdom. It's rational. The people calling Gen Z naive are often the same people who made the credential bet at maximum cost, and are still paying for it. Their advice is compromised by sunk cost. They need to believe the path they took was correct. The psychology of that is understandable. The financial advice that comes from it is dangerous. Here's the thing I want to say plainly. Security and freedom are not opposites. That framing is one of the most expensive misunderstandings in personal finance. The conventional framing says you trade freedom for security. You accept constraints, location, schedule, job function in exchange for a predictable paycheck. And that trade made sense when predictable paychecks actually predicted your future with some accuracy. When the company wasn't going to restructure you out in 18 months. When the pension was real. When the salary tracked inflation. The trade made sense because the thing you were getting in exchange for your freedom was actually valuable. But when the security side of the trade degrades, when the paycheck stops tracking inflation, when the company loyalty evaporates, when the employment relationship becomes essentially at will in practice, the trade stops making sense. You're still giving up the freedom, you're just not getting the security anymore. You're paying full price for a product that no longer exists. That's not a value shift, that's a pricing correction. What Gen Z actually chose, the segment of them making this work anyway, isn't freedom in the abstract motivational poster sense, it's a specific portfolio of optionality. The ability to change direction quickly, the ability to capture upside that an employer would otherwise capture for themselves, the ability to build assets instead of just earning income, the ability to not be one decision by one manager away from financial catastrophe. That's not idealism, that's risk management. The escalator is a single point of failure. The stairs, plural income streams, plural skills, plural assets, is a distributed system. Distributed systems are more resilient. Any engineer will tell you that. Let me give you a short story to illustrate the psychology here. I want you to imagine a 23-year-old, smart, graduated with a decent degree, maybe accounting or marketing, nothing exotic. She gets a job at a medium-sized company, 70-hour commute week when you factor in the drive and the hours, salary of $46,000. Her manager makes $62,000. Her manager's manager makes $85,000. She can see every step of the escalator from where she's standing. She knows exactly what the ceiling looks like at every floor. She knows that getting from 46 to 62 takes probably 4 to 6 years of performance reviews and navigating office politics. She knows that getting from 62 to 85 is mostly about not making enemies and outlasting the other people on the same step. She can see the whole machine. And the machine is telling her that her best case scenario, if she executes perfectly, is a $62,000 salary in 5 years. Meanwhile, the YouTube channel she started on weekends is making $400 a month in its third month, which is nothing, but it's also doubling every few months. And more importantly, it's an asset she owns. It appreciates. It doesn't cap at $62,000 because a budget cycle says it does. She doesn't quit her job, she's not reckless, she runs both tracks in parallel until the independent track clears a threshold that makes the comparison obvious. And then she makes a decision based on numbers, not feelings. That's the model. That's what I mean when I say this isn't about freedom as a value. It's about freedom as a financial structure that under current conditions produces better expected outcomes than the alternative. The freedom is a feature of a superior system, not a preference that overrides financial logic. Now I want to get into something darker, because we've been talking about the economics like it's a clean optimization problem. It mostly is. But there's a psychological dimension that makes this harder than just running the numbers, and that dimension is social proof. Humans calibrate risk through comparison. We look at what the people around us are doing and use that as a proxy for safety. If everyone is doing X, then X must be safe. This is a useful heuristic in stable environments. It's a catastrophic heuristic in environments that are changing rapidly. Because in a changing environment, what everyone is doing is often exactly what no longer works. The crowd is optimized for the last decade, not the next one. And this is where I think Gen Z is genuinely navigating something difficult that doesn't get enough credit. The social pressure to get on the escalator is intense. It comes from family, it comes from culture, it comes from the architecture of the education system, which is structurally designed to produce employees, not owners. And resisting that pressure requires not just a different financial belief, but a different psychological operating system. You have to be comfortable being the person at dinner who says, I'm not sure I want a traditional job, and watching people look at you like you said you're going to live in a van and eat granola. The social cost of deviation is real. And for a lot of people, that cost is enough to keep them on the escalator even after they know it doesn't work. This is the third escalation, because now we're not just talking about financial systems. We're talking about the incentive structures that keep bad systems alive long after they stop working. The escalator stays crowded not because it's the best route, but because the entire social infrastructure around you, your parents, your school, your government, your bank, is optimized to put you on the escalator and keep you on it. It's not a conspiracy. It's just that all of these institutions were built during the escalator's golden era. They're all structurally aligned to produce escalator passengers. The advice they give you flows from that structural alignment. They genuinely believe the escalator is your best option. Because it was for them, in their context, with their conditions. Their advice is historically accurate and currently wrong. And there's no easy way to resolve that tension without making the people you love feel like their life choices are being invalidated. So most people don't. They get on the escalator, they manage the discomfort quietly. Here's a quick sarcastic detour. My favorite genre of LinkedIn post is the one that goes, I worked at the same company for 31 years, I showed up every day, I never complained, I gave them everything. And last Thursday they eliminated my role in a restructuring. But you know what? I'm grateful. Because it taught me resilience. Brother, that's not a lesson. That's a hostage situation with good branding. Okay? Back to the actual mechanics. The fourth escalation is where this gets counterintuitive in a way that I think genuinely surprises people. Because here's the thing. Gen Z's choice of freedom over security isn't just producing better expected financial outcomes for the individuals who make it. It's changing the economy in ways that are going to accelerate the divergence between the two paths. Let me explain. When a significant portion of young people stop feeding the traditional employment pipeline, when they stop competing for the same jobs, stop accepting the same suppressed wages, stop providing cheap, compliant labor to companies that depend on it, those companies have to adapt. Some of them raise wages, some of them offer more flexibility, some of them develop better culture, and some of them automate. And the ones that automate are inadvertently proving at scale that the jobs they're automating weren't really safe to begin with. The automation wave isn't happening to people who took the independent path. It's happening to people on the escalator. Because those are the jobs that are systematically replaceable. The jobs that are rule-based, repeatable, and optimized for efficiency. The jobs that the escalator was built to deliver people to. Meanwhile, the skills that Gen Z's independent workers are developing, creative direction, community building, audience psychology, product development, brand strategy, digital distribution, those are the skills that are genuinely hard to automate. Not because machines are incapable of creativity in some philosophical sense, but because the economic value of these skills is tied to human trust, human relatability, and human judgment in contexts where those things matter to other humans. You can automate the production of content. You cannot automate the trust that an audience has in a specific person. That trust is the asset. And it compounds. An account with 1 million subscribers and 10 years of consistent voice has a moat that is nearly impossible to replicate quickly, regardless of how good the AI tools get. So the people who spent the last 5 years building audiences and independent operations are sitting on compounding hard-to-automate assets. The people who spent those same 5 years waiting for their annual review are sitting on an employment relationship that is progressively more exposed to replacement. That's the fourth escalation. The people who seemed to be taking the risky path were actually hedging against the major macro risk of the decade. And the people who seemed to be taking the safe path were actually accumulating exposure to it. I am not saying everyone needs to start a YouTube channel. That's not the point. The specific mechanism matters less than the principle underneath it. The principle is, build something you own. Assets compound, income doesn't. A salary is a rental agreement on your time. The moment the agreement ends, the income ends. An asset, a business, an audience, a portfolio, intellectual property, a platform, continues to generate value independent of any single relationship or contract. The escalator gives you income. The stairs can give you assets. And over long enough time horizons, the gap between those two outcomes is not small. It is enormous. Let me put some numbers on enormous. Take 2 people, same starting conditions, same age. One of them earns $60,000 a year for 30 years with a 3% annual raise and a reasonable 401k. At retirement, they have somewhere around $900,000 in the 401k, assuming decent market returns, plus maybe a paid-off house worth $400,000. Call it a total net worth of $1.3 million at 65. That's not bad. That's actually a successful outcome by the traditional metric. Most people on the escalator don't even get there because life happens, medical expenses, divorce, layoffs, bad markets at the wrong time. But let's say everything goes right. 1.3 million at 65. Now the second person, they spend 5 years building an independent business that by year 5 generates $120,000 a year with relatively low overhead. They invest aggressively because their expenses are controlled and their income growth isn't capped. By age 30, they're investing $40,000 a year. By 35, $60,000 a year. By 40, they own a business with real asset value, not just income. Let's say it's worth 5 times its annual profit, conservatively. That business alone, at $300,000 profit a year, is worth $1.5 million as an asset you could sell. Plus the investment portfolio they've been building since 25. Plus the real estate they bought when they had the cash flow and credit profile to be strategic about it. The ceiling on this path isn't 1.3 million at 65. It's 10, 15, 20 million before 50 if the compounding runs cleanly. The gap between a well-executed independent path and a well-executed traditional path isn't marginal. It's multiple orders of magnitude, and yes, I know not everyone executes it well, most people don't. That's true of both paths, but here's the asymmetry that matters. On the traditional path, there's a ceiling on the upside. The escalator can only move so fast. On the independent path, there's no ceiling. The risk-reward profile is genuinely different. The traditional path has lower variance and a capped return. The independent path has higher variance and uncapped return. For someone young with minimal obligations, no dependence, and a long time horizon, which describes most of the Gen Z cohort we're talking about, the math of risk-reward very clearly favors higher variance and uncapped return. You take the big swings when you have time to recover from the misses. That's not recklessness. That's appropriate allocation of your risk capacity. The reckless thing is to cap your upside when you have 20-30 years of runway in front of you. Let me do a quick second comedic moment because we've been very serious for a while. The financial advice that gets handed down from parent to child in the average household is something like, make sure you have a good job with benefits and a retirement plan. And that advice is genuinely well-intentioned, and it was excellent advice in 1987. Today it is roughly equivalent to telling someone to make sure their Blockbuster video membership is current. The building is gone, the parking lot is a meditation studio now. But we keep giving the advice. Now I want to talk about something that I think is underappreciated in this conversation, and that's the role of identity in financial decision-making. Because this entire thing isn't just about financial logic. It's about what kind of person the system tells you that you are. The traditional employment structure tells you that you are an employee. Your identity, your schedule, your social relationships, your health insurance, your sense of professional worth, all of it flows through the employment relationship. The company is the context in which you exist as an economic actor. And that's a profound structural dependency that most people don't fully register until the relationship ends. And it ends for everyone, eventually. You retire, you get laid off, you leave, the company dissolves. And a lot of people in that moment experience something that looks less like financial stress and more like an identity crisis. Because the identity was housed in the institution, and now the institution is gone. The escalator delivered them to a floor that wasn't actually there. Gen Z's rejection of this, I think, comes partly from watching the generation above go through exactly that. Watching parents and relatives and older colleagues have their identities quietly dissolved by restructuring events, and deciding, consciously or not, that they don't want to build their identity inside something they don't own. The freedom they chose isn't just economic freedom. It's a form of identity sovereignty. And in a world where the employment relationship is increasingly transactional and unstable, identity sovereignty is a rational thing to want. It's not soft, it's structural. Here's my 3-level framework for understanding how people relate to the security versus freedom trade-off. And this is important because I think it helps explain why some people make the transition and some people don't. Level 1 is compliance. This is the person who's on the escalator because they were told to be on the escalator, they don't have a strong opinion about it, they just did what the system asked. They studied what they were supposed to study, applied to the jobs they were supposed to apply to, accepted the first offer they got, and have been ascending slowly ever since. Most people are at level 1. Not stupid, not lazy. Just moving with the current because the current is all they've ever seen. Level 2 is optimization. This is the person who looked at the escalator, decided they wanted to climb as fast as possible, and put in the work to do it. They networked aggressively. They got the MBAs and the certifications. They job hopped strategically to accelerate their salary. They maxed the 401k, invested in index funds, and are honestly going to end up in a pretty good place financially. But they're still on the escalator. They're moving faster than everyone else on the same conveyor belt, but they're still subject to the same ceiling, the same single point of failure, the same structural dependencies. They optimized within a constrained system. Level 3 is architecture. This is the person who looked at the escalator, understood exactly how it worked, and decided to build a different machine. Not a better escalator. A different system entirely. One where they own the asset, not just the income. Where the ceiling is determined by the market, not by HR. Where the risk is distributed across multiple streams instead of concentrated in a single relationship. Most people who get genuinely wealthy by their 30s are operating at level 3. Not because they're more talented, because they changed the game they were playing. The interesting thing about Gen Z is that they have a higher proportion of level 3 thinkers at a younger age than any previous generation. And I think that's partly because the tools are available, and partly because they had a front row seat to watching the escalator break. Both of those things matter. You need the evidence and the infrastructure. Gen Z has both. Now I want to come back to the original hook. I said at the start that Gen Z chose freedom over security because they did the math, and the math didn't work. But I want to complicate that slightly, because it's not purely rational. There's also a grief component. Underneath the rational optimization is something sadder. A generation that genuinely wanted the deal. That wanted the stability, the clear path, the house, the career ladder, the retirement at 65. That wanted to trust the escalator and discovered that the escalator no longer goes where it says it goes. And the grief of that, the loss of a future that was promised and then not delivered, is I think one of the more significant and under-discussed aspects of what's happening economically right now. The cynicism that shows up in Gen Z's financial content and financial philosophy isn't a personality trait. It's a scar from watching a system fail the people who trusted it most. And I want to be clear, I'm not saying the new path is easy. It's not. Building something independently is genuinely harder, at least in the early stages, than getting on the escalator. It requires tolerating uncertainty. It requires developing skills outside a structured curriculum. It requires making decisions without a manager to defer to. It requires taking responsibility for outcomes in a way that employment insulates you from. Those are real costs. The escalator was a real product. It provided real value. It just stopped delivering on its core promise at some point in the last decade or two. And the generation that grew up watching it fail is not going to keep buying tickets just because the alternative is uncomfortable. So what do you do with this? Here are 3 practical takeaways that aren't generic. First one, audit what you own versus what you earn. Most people can tell you exactly what they earn. Very few can give you an accurate picture of what they own. Income is a flow. It runs and then it stops. Assets are a stock. They accumulate and compound even when you're not working. If your current financial life consists entirely of income with no asset accumulation happening in parallel, you are in a structurally fragile position regardless of how large the income is. The first priority of level 3 thinking is to begin converting some portion of income into assets as early as possible. A 401k counts but barely. A business, a content platform, a rentable skill with a growing market rate, equity in something you understand, that's what I mean by assets. Second one, build a second track before you need one. The worst time to start building an alternative income stream is when you've just lost the primary one. The best time is when the primary one is stable and the pressure is low. Use stability to take smart risks, not to coast. The people who end up with optionality didn't build it during a crisis. They built it during a period of normalcy, quietly, in parallel with whatever they were already doing. It doesn't need to be big immediately. It needs to start. The compounding can do the rest. Third one, stop trading freedom for the feeling of security. The escalator does not protect you, it protects itself. The rules of the employment relationship are designed to serve the institution's continuity, not yours. The faster you internalize that, not bitterly, not resentfully, just clearly and analytically, the faster you can start making decisions that actually serve your compounding interests. Job security is a myth that has been maintained past its expiration date by people who benefited from others believing in it. The new security comes from owning things. Full stop. If this is the kind of analysis you want more of, subscribe.